So word on the street is banks are freezing up. I don't know if they're really freezing up, but they're certainly not lending the way they were. They're slow to close, they're slow to issue new loans, and they're fast to say no. So what the heck is going on with the banks? That's what I want to cover today. I want to go into the facts of why banks are not lending, or why are they kicking your deal down the line? Why is it your deal isn't closing on time? You're probably asking these questions, but that's what we're going to talk about. My name's Chris Naugle, and this is What Now? What's next for banks? Banks. You know, we all need them, right? Well, not all of us, but most of us need banks. We need them to make our deposits because that's what we were told to do. We need them for the loans, for our cars, our boats, our houses, and our investment real estate. I mean, we have been so conditioned to rely on the banks for everything. We take our hard-earned dollars, we give them to the bank takes them and lends them back out. But wait.
Hold up, wait a minute.
Do they actually lend the money back out? Because right now, I'm telling you, from what I'm seeing and what I'm hearing on the street, banks aren't really lending. They're making it really difficult. Now, let me give you a personal story. Not long ago, I had one of my commercial mortgages mature. So all commercial mortgages, let me explain, they're not like your house mortgage. Most of them, if you do them as commercial, have a fixed rate lock period. And that's usually 5, 7, I guess maybe there's 10-year ones, but I just know of 5, 7-year rate locks. So that means back 5 years ago, I took out a mortgage for an investment property, a rental. And that rental mortgage matured. What does that mean? Well, my rate lock ended. Now, can you imagine 5 years ago where rates were? You can. It seems like it was yesterday, right? Rates were like 3, 4, 5%. On the commercial side, my mortgage rate was 5.25%. I mean, we were all so excited about those low rates because we could buy rentals and our payments were really low, which means we made a bunch of money on the rental. But hold on, that rate lock expired because it's been, yes, 5 and in some cases 7 years since those low rates. Matter of fact, we were in an artificially low interest rate environment. So we got so used to it that then when that letter comes from the bank saying, hey, your rate lock has expired, you need to refinance your mortgage. And then I'm like, okay, no big deal. So I went to refinance and they want all new documentation again. Personal financials, they want all your stuff, pull your pants down, they check the size, they make sure everything's good, and then they say,
hey, yes, I think we can do this mortgage.
What do you mean you think? You already have the mortgage, all you're doing is just resetting the rate. What's my rate gonna be?
Well, that's the bad news, Chris. Your rate's gonna go to 8.25%.
And I'm sitting there, I'm like, wait a second, hold on. 525, 625, 725, 82, 3 points higher? What the hell's going on? But you all know what's going on. The Fed printed a whole bunch of money during the pandemic, created a whole bunch of inflation, which they won't take responsibility for because it's transitory, and then, oh, there's not an inflationary problem. Then there is an inflationary problem, but it's okay because we got the levers and we'll fix this. We'll just jack interest rates way up really fast. Oh, and guess what that did? Well, it not only doubled didn't double my interest rate, but took me from 5.25 up over 8%. And that's the same case for all commercial mortgages. But you know what else it did? It destroyed banks. Do you remember back a few years ago, there was Signature Bank, there was Silicon Valley Bank, there was Republic Bank, and a bunch of other ones, and they all went insolvent. There was a run on the banks. And I did a video on this, but you remember why that happened? Because when the Fed increased interest rates really fast, from like 0 now to 5.25 to 5.5, that's a big increase, and they did it super fast to slay the inflation dragon. You know what that did to the bonds that banks hold? They crashed down. That's what happens. When interest rates go up, the price of treasury bonds, government-issued bonds, goes down. The longer the duration of the bond, the steeper the decline in price. And then when the Fed drops interest rates, the price of the bonds goes back up. Pretty simple, right? Yeah, but you don't want to be on the side where you own a bunch of bonds when the Fed's increasing interest rates because the price of your bonds goes down, which isn't a big deal if you don't need the money. But you see, when the bank has a run on the bank, like Silicon Valley did, like Republic did, like Signature did, and they need to go into the reserves, and the reserves are held with treasury bonds. Why? Well, because that's what the regulators tell them they have to do. And then all of a sudden they look at their balance sheet and they're like,
guys, come here. Do you see this? Our bonds used to be worth this, and now they're worth this, and these people want their money back. Tell them no. We can't tell them no. It's their money. Well, we can't sell these bonds. We're gonna lose a bunch. We can't not give them their money back. What do? Give them their money back. Sell the bonds at a loss.
Well, you know the rest. So now, let's fast forward to 2024, where we're at now, where banks are freezing up. Why? Well, let me give you 5 reasons. And there's this great article right here that I want to kind of pull these from, but I summarize them really quick. Check this out. Why banks aren't lending was the article. Now there's 6 reasons why this article states banks aren't lending. And I'm gonna cover them, but I'm gonna kind of abbreviate them and talk about 5th grade level. Is that okay with you? All right, so first, I mentioned the regulators. So remember, the regulators had to step in and they had to save those banks. They didn't actually save those banks, they saved the depositors and they paid them their money back. They made them whole on their money, which was above, just so you know, the 250,000 FDIC limits for many of them. But don't expect that to happen again. So regulators now, the reason number 1 banks are freezing up, regulators have gone in and told banks they have to hold more in reserves because they don't want another one of those issues where the bank becomes insolvent and the regulators and FDIC and the government all got to step in and be like, what are we gonna do? Well, they're gonna have to print more money, tax more people to pay for the printed money. Something like that anyway. But the regulators don't want that to happen. So the first reason is banks have now had to hold more in reserves because the regulators have clamped down so that they don't have another situation, if that's what we're going to call it. But let's move on to the second reason. The second reason is a really good one, and as you can see right here, banks are holding on to more reserves themselves. So not just because regulators are telling them, the banks are actually holding more reserves because the banks are starting to see delinquencies go up. And that means defaults are coming soon. So first delinquencies and then defaults. Makes sense, right? People get behind on their bills. People can't afford their loan payments because the stupid Fed increased interest rates so much that people's payments have gone up. So if you had a home equity line of credit or a line of credit for that matter, you probably went from about 3% back in the good old days to right around 7-8%, right? Well, also, if you had a credit card, you probably went from, I don't know, a high rate to a super high rate, right? So all these things adjusted up, which means everybody's payments went up. Not only did their payments go up, the cost of everything, goods and services, also went up because of inflation. And hey, don't tell anybody, but the cost of goods and services really didn't go up. It's just your dollar buys less, because when they print $5 trillion or over 10 trillion, if you really want to count back to 2008, what happens is all that new money they print has to get value from somewhere. So here's what happens. Like when they print a dollar, it takes your current dollar in your wallet and it has to steal a little bit piece of it, okay? And then they print another dollar and it steals another little piece, and another dollar, and another dollar, and $5 trillion, and $10 trillion. And then your dollar kind of looks like this. It has lost its buying power. But this has been going on for a while, and that's boring, and you already know that. But so anyway, let's get back onto it. So banks are gonna hold more in reserves because they know a lot of people are gonna go delinquent and then default. So they want to make sure that they're prepared. So that's the second reason. Now let's go on to the third reason, and this is one that should hit home because I talk about this all the time. Recession fears, uncertainty about the future, right? Well, banks are also uncertain, and banks are also concerned that there's a recession coming. They know the same things I know and that Ray Dalio knows. They know it's coming. But hey, I know another thing. And that is that you need to do something. And that is click that little subscribe button right there. And there's a little bell up top. Whoa! Smash that bell. Just like you'd like to smash your banker's face sometimes when they don't approve your loan, or they then tell you your loan's not closing, or the Fed, they said, oh, well, we're gonna close, but we don't know when. It's like a little punch right in the face. Anyway, just smash that little bell and we can get on with this thing. So let's keep going. So we've covered 3 reasons. Regulators increasing the amount of reserves, banks just holding more in reserves, uncertainty about a recession coming. So what are the rest of the reasons? Well, the 4th reason is easy. Small and regional banks, okay? Community banks and just your small down-home banks. Well, during the really good times, the glory days, we'll call them, when rates were really low, these banks did a lot of commercial lending. Now, just so you know, commercial lending just means the bank is lending to a company. It could be a single family rental, could be a multifamily, could be a giant complex. You know, a lot of people think commercial is these giant buildings, but commercial is just meaning the bank is lending to a business. But commercial loans are in a little bit of trouble since the pandemic, aren't they? Like, imagine those big office buildings that you see every time you drive in your car. Those big office buildings, many of those office buildings are almost vacant because, well, during the pandemic, we started working from home and people just never went back to work. So companies don't need all that office space anymore, but they're still making their payments because, well, they don't want to default. But eventually, when the loan goes to mature, are these big companies going to continue to pay? Or when we go into a recession, are they going to continue to pay? So what I'm trying to say is the 4th reason is there's a ton of risk on the books with small and regional banks because of their exposure to these giant commercial loans, or these giant portfolios of commercial loans is what I should be saying. Now that's a real concern, and I covered that before. So let's go on to number 5. Interest rates. There is so much uncertainty right now around interest rates. And interest rates, because of the uncertainty, are meaning that banks are sort of just saying, hey, we're gonna kind of wait and figure out what the Fed's gonna do. We've been hoping the Fed's gonna drop rates and free some of this stuff up, but we don't know, so we're just gonna hang on. And that means you're gonna hang on too for that loan. And that means your refinance or your closing is just gonna hang on. There you go. Tough shit. Because listen, this is off the topic, but banks have no ramifications for not closing on your loan. They have no penalties, nobody's gonna slap their hand if they don't close. So if you think you're closing this week on a deal, but then the bank says, oh, sorry, we gotta push that to next week. Oh well, burden's on you. That means you got to call your title company and your attorney, have the numbers redone for next week's closing, because obviously the interest calculations are going to be different. Next week comes, and the bank's like, I'm sorry, we're still not ready. Kicks the can the next week. You go back to your attorney, your title company, repeat that process, and you keep doing this. Do you think that costs a little bit of money for the sellers or the investors looking to refinance or get money from the bank? It does. But does the bank care? No, they don't give a shit. And now, let's talk about the 6th and final reason banks are freezing up according to this article. This is a good one. Interest rates went way up, which means bonds in the reserve accounts, price went way down. So banks are sort of upside down there. But not only that, banks' cost of capital has gone up. Because when interest rates go up, that means banks have to pay more, right? Didn't banks have to pay you more interest on your savings, your high yield savings, your CDs? They did indeed, which means they have to charge more on loans, but also means their cost went up. And a lot of the loans they have out there at 3% or 4% from back in glory days, now the cost of capital might be 5%. But not only that, when the bank borrows from the Fed or from the central bank, the overnight rates also went up. So their overall cost to operate as a bank has increased, meaning they're not as profitable, meaning they're a little bit fragile, meaning they're a little bit irritable and they're not closing on your loan. Capiche? Great. Well, let's talk about this next article because I think this one's a pretty good one too. Banks. Banks are ditching branches at an alarming rate. I don't know if you've noticed this, but driving around, you notice less bank branches? especially all the big ones. Look at this article. Look at all these banks that are shutting down branches. Last year, 2,454 branches closed, just last year. How many are going to close this year? And what about next year after this election, when we're in a recession? Because I think that's where we're headed. How many are going to close then? Well, you can see the writing on the wall. So get used to online banking. Get used to those terrible service centers that you got to call when something doesn't work or your password isn't going in, or you answered blue car when actually it was a black car, and it asked you this weird question about the mascot of your high school, and you're like, shit, I didn't play any sports in high school. I don't know who the mascot was. So you answered the little elephant, and it wasn't. It was the tiger, and now you're shut down and your bank account is frozen because you can't log in and do anything because there are no branches. Yeah, you see where I'm going with this? Oh yeah, you could call them, sure. And then you hit 1 for this, and then 3 for that, and then 6 for this, and then you end up in no man's land, and then you don't get anybody, and you're back to hitting 0 for the operator, and it disconnects. It's such a fun game. We don't even need Nintendo anymore. We just call the bank, and it's just like playing Tetris. You'll never win the game. All right, anyway, let's be serious and move on, because big banks are paying low interest on savings. This is a great article right here in Yahoo News. I knew this, but I didn't know the ramifications. I knew that banks were hardly paying any interest on people's deposits. And I'm talking about right now when interest rates are really high. That's right. A lot of people are getting pissed off, especially banks with the brokerage divisions. They have these cash sweep accounts. And these cash sweep accounts, the banks aren't really paying their customers hardly anything. But the banks are making a bunch of money on this cash sitting in these cash sweep accounts. So, well, as everything else, there's lawsuits. That's right. People are suing the banks and saying, hey, interest rates are high and you guys aren't paying us our fair share, so we're going to sue you. Well, more on that later, but I don't think anything will come of it. The bank will settle with them, pay them a couple bucks, give them a Snickers bar or a Kit Kat and say, go, go, shoo, shoo, and then they'll just keep doing the same thing. But here's another interesting thing, and I actually was surprised when I saw this article, but it's about the stress test. So the news is out. A lot of these big commercial banks have had to go through stress tests, because the regulators, like I'd mentioned earlier, are trying to make sure that banks are solid, making sure that we don't ever do another 2008 financial crash like the Great Recession was. So they're stress testing these banks, and lo and behold, the banks are passing the stress test. So you have to make a conclusion of one of two things is going on. Banks are in better financial health than we might have thought, or number two, just like the jobs reports, it's all bullshit. And they're just telling us what we want to hear, saying, oh, everything's great, the banks are in really good shape. Well, so if you read this article right here from Reuters, it explains that banks, well, most of them, if not all of them, are passing the stress test. Woo! Awesome. Awesome. They're passing the stress test, but they certainly aren't going to refinance your mortgage. They certainly aren't going to give you money for that business opportunity. Oh no, they're probably not going to give you any money for that either. No, they're definitely not going to give you money for that. It doesn't matter what you look like on paper. They'll find a reason not to give you a loan. They'll just tell you no. And you'll be like, why? And they'll say, because we said no. It's kind of like, when you're talking to your child and your child says, why? 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 Because I'm your parent and I said no. And the banks are like, because I'm the bank and I said no. End of story. Anyway, I got another one here that's pretty interesting. On the stress test thing, and this is just me kind of speaking, but I know a thing or two. Credit cards. So if banks are passing the stress test, riddle me this. All the credit cards out there, because if you looked at the charts I've talked about on credit card debt, it has gone up, up, and up. There's over $100 billion in credit card debt. Oh, and also, here, I wrote this down. This is pretty interesting. Of the $100 billion, delinquencies have gone up 40% on credit card payments. So you got a $100 billion nut, and delinquencies are up 40%, but yet they're passing the stress test. Do they really have that much money? I guess they could, because like think about it. The Fed printed over $5 trillion, and a lot of that money probably went into the banking system. And banks made a ton of money during that period of time. So maybe they're okay, but I mean, $100 billion? And delinquencies up 40%? Shoot, man, I'd not be sleeping at night if I was running that bank. And not only that, the commercial real estate loans that I mentioned earlier, you know how much that is? $142 billion. So we got $100 billion in credit cards and climbing, and $142 billion in commercial real estate loans out there, which are kind of teetering like, is it gonna make it? Is it not? What's gonna happen? Anyone know? It's kind of like a game show. I don't know. But so listen, folks, all of this stuff is what's going on, and there's one final thing I wanna cover. I'm not trying to scare you here, there's a lot of info on this. The Fed's balance sheet. So I don't want to get into the balance sheet and what it is and that, but the Fed has control of monetary policy. So when everything was falling apart during the pandemic or the financial crisis or any of those, what was happening is the Fed was gobbling up a bunch of bonds, right? They were just putting bonds on their balance sheet. They went from like 4 trillion to like 9 trillion at its height. But then when inflation went crazy, one other thing they did, not just increasing interest rates, but they said they were going to unwind their balance sheet, which means they were going to let bonds mature because they were buying bonds from the US government, okay? And then those bonds mature. 2 months, 6 months, 2 year, 5 year, you know, they mature the bonds. And when they mature, normally the Fed would just renew them, right? But now they're not. They're just letting them mature, which is kind of like you ever see the movie Spaceballs? I do this all the time, but I think it's a great analogy. You know, where Helmet flies his big ship to the planet, which clearly we know was Earth, but they called it something else. And they hooked the vacuum cleaner up to Earth, and like that little door opened, and then they started sucking all the air out of the Earth. You remember that? Well, imagine the Fed hooks their vacuum cleaner up to the central banks, to the banking system, and just turns their vacuum cleaner on high and just starts sucking money out. Do you know how much money they sucked out? Well, let me just tell you, I got it right here. So June of 2022 to date, they reduced the size by $1.5 trillion or 18% from its peak size. The Fed's balance sheet can be described, so anyway, it doesn't matter, but they reduced the balance sheet by a tremendous amount, which means there is $1.5 trillion or 18% less money in the banking systems. So remember I said in the beginning, it seems like banks are freezing up. Well, I think it's conclusive why banks are freezing up. I gave you 6 reasons, and I also talked about a bunch of other stuff, credit cards, commercial loans, fear of a recession, and all these things. So listen, folks, I mentioned it in another video that I did before, all about where the opportunity lies in this. The opportunity is easy to see. If banks are seizing up and you got some cash in your IRA, maybe an old 401k, maybe cash value in that specially designed whole life, or you just got some money sitting on the sidelines and you're trying to make some more, become the bank. You know, a wise man once told me, he said, the ultimate in real estate is being the bank. Well, if banks are freezing up, if banks aren't lending, but deals are getting better and better because the price of real estate is coming down and down and down, creating more opportunity, where's the opportunity for us? The opportunity is in you becoming the bank. If you got some cash, if it's a retirement account, move it into a self-directed IRA. I use Horizon Trust. I've been happy with them. You can check them out, horizontrust.com. But if you're interested in learning how to be the bank, go to privatemoneyclub.com. I've got tons of videos on there, free videos, or just watch this YouTube channel. Remember I did say subscribe and click that little bell? Yeah, well, I put videos out all the time on how you can be the bank and how you can lend money and you can take over where the banks are failing. You see, the biggest opportunities come when everything's falling apart. And the biggest opportunity definitely is coming to a theater near you because banks are not lending, which means you, me, and everybody else should be the bank. And we can make a bunch of money. And we can be super safe with it. And because we can take positions, first, second, or third lien position on the property. Yeah, hey, we can do it just like the banks. So folks, if you want to learn more, go to privatemoneyclub.com, watch the free videos, no cost at all to you, or check out more videos on this. But folks, that's a wrap for today. Get on the program, understand why banks are doing what they're doing, and understand where the opportunity lies in the chaos. And the opportunity is in you being the bank. Thanks for joining me. My name's Chris Naugle. This has been another episode of What Now? What's Now? Hey, if you like this video, check this one out right here. It's another video I did on banks. and why they're not lending. See you next time.